Imagine this. You are spending more than you earn every month. You keep buying things from others and taking loans to fill the gap. Now, picture this happening at the level of an entire country. That is exactly what many major economies are doing today, including the United States. But this is not just a case of bad budgeting. It reflects deeper issues in how nations grow, trade, and spend. Today, we are diving into the world of deficits, fiscal and trade, to understand what they mean, why they matter, and how they shape the global financial system. Hello and welcome back to the channel. If you are a finance professional, a policymaker, or an investor, this video will give you a clear framework to understand the twin deficit challenge, not just in the United States, but also in emerging economies like India. We will break down complex ideas into simple, relatable concepts with real-world examples. So, stick around till the end. Let us start with the basics. At its core, a deficit simply means you are spending more than you earn. That is true for individuals, businesses, and governments. For countries, there are two major types of deficits: fiscal deficits and trade deficits. Let us begin with fiscal deficits. A fiscal deficit happens when a government's expenses exceed its income from taxes. Think of it like a family that earns 1 lakh rupees each month but spends 1,20,000. To cover the extra 20,000, they use a credit card. For governments, this credit card is borrowing, typically through issuing bonds. Over time, this adds up and becomes the national debt. In the year 2024, the fiscal deficit in the United States was $1.83 trillion. That means they spent $1.83 trillion more than they earned through taxes. And just like interest piles up on a credit card, the interest on this debt keeps growing. By the year 2026, the United States is expected to pay over $1 trillion every year just in interest. That is more than the entire education budget of India. So why is a large fiscal deficit a concern? There are three big reasons. Number one, crowding out. Imagine the government is a giant vacuum cleaner sucking up all the money in the system. When it borrows heavily, there is less money left for businesses and startups to borrow. Interest rates go up. Loans become more expensive. This slows down private investment, which means fewer jobs and slower economic growth. Number two, inflation. When governments spend more money without a matching rise in productivity, there is more money chasing the same amount of goods. That pushes prices higher. It is like pouring too much fuel into a car engine. It overheats. After the COVID pandemic, governments around the world, including India, pumped trillions into their economies. That led to one of the sharpest inflation spikes in decades. Number three, investor confidence. If global investors start doubting whether a country can manage its debt, they demand higher interest to compensate for the risk. Or worse, they just pull their money out. That weakens the currency, raises borrowing costs, and can lead to a financial crisis. But let us be clear, not all fiscal deficits are bad. During economic downturns, when private sector spending falls, government spending helps revive demand. This is called counter-cyclical spending. The problem arises when deficits remain high even during good times. That shows deeper structural issues. Now let us move on to the second type, the trade deficit. A trade deficit happens when a country imports more than it exports. Put simply, it is the value of imports minus the value of exports. In March of 2025, the United States recorded a trade deficit of approximately $138 billion. That means it bought far more goods and services from other countries than it sold. Think of a shopkeeper who keeps buying stock from wholesalers but does not sell enough to customers. Over time, the cash runs out and they must borrow or sell assets to stay afloat. The same applies to countries with persistent trade deficits. Now here is the interesting part. Trade deficits weaken a country's currency because more domestic currency is going out to pay for imports. However, the money often comes back as investment. For example, the dollars China earns from selling goods to the United States are often reinvested into US stocks, bonds, and real estate. This helps keep US capital markets stable. India's trade deficit is often financed through foreign investment, whether it is foreign direct investment in sectors like manufacturing and technology, or foreign portfolio flows into stocks and bonds. But this kind of investment is volatile. It can leave overnight. And that makes India more vulnerable than the United States. Now comes the real challenge. When a country has both a fiscal deficit and a trade deficit at the same time. Economists call this the twin deficit problem. It is like maxing out your credit card and taking out a personal loan to cover your lifestyle. That double borrowing makes a country highly dependent on foreign capital. And if global investors lose trust, the consequences can be severe. Let us compare two countries. The United States runs both deficits. But the world still buys US Treasury bonds and holds US dollars. Why? Because the dollar is the global reserve currency. That gives the United States enormous financial flexibility. India, on the other hand, does not issue a global currency. We must earn every dollar we use, usually through exports or foreign investment. That means our twin deficit risk must be managed carefully. The Reserve Bank of India actively monitors the rupee, builds foreign reserves, and adjusts interest rates to keep the system stable. Now take countries like Turkey or Argentina. They also run twin deficits, but without strong global trust. When sentiment shifts, their currencies collapse, inflation soars, and investors rush for the exit. To simplify, the United States is like a global supermarket. It can run a tab and still get credit. India is like a mid-sized retail chain. We have to keep our books clean and our suppliers confident. And emerging markets like Argentina are like local shopkeepers. Any sudden shock and they are in trouble. So, what is the key takeaway? Deficits by themselves are not bad. They are tools. But if misused or left unchecked, they can become serious liabilities. Whether you are managing a national budget or just looking to understand global economics, knowing how deficits work will help you see the early signs of financial stress. If this video helped clarify something complex, please hit the like button, subscribe to the channel, and share it with someone who needs to hear this. Because when it comes to global finance, the real danger is not the deficit you can see. It is the one you fail to understand. Thanks for watching, and I will see you in the next one.